Hello everyone, and welcome to the TradeShark Weekly blog, where each week we will take a look at the settings and indicators found exclusively within TradeShark. This week we will examine the triple crossover. This indicator utilizes TradeShark's predictive technology to produce a better, more reliable trading tool that not only confirms longer-term trends, but also identifies shorter-term trade setups that offer great reward relative to risk. I'll demonstrate a few of these techniques shortly, but first, let's take a look at the indicator on its own. The triple crossover consists of three predicted moving average values, which can be thought of simply as short, medium, and long term. Traders can utilize any combination of these values to support their individual trading techniques. However, generally, once both the short and medium-term averages are above the longer-term average, the market is considered bullish. If both are below the long-term average, like you see here on the chart, then the market is considered bearish. Aside from confirming trend direction, the triple crossover offers some very helpful support and resistance levels that are ideal for shorter-term trading. Probably the most important level of the three is the long-term average. Often, when markets move into a strong trend, the market will eventually pause and consolidate. This is often an excellent time for traders to enter the market as a continuation trade. However, traders need to know how big that consolidation or pullback will be, and what prices they should accept to get involved with a market. For example, let's say that I was looking to get long the British pound, staying in line with the uptrend. If a trader was looking to take a new position, he should wait for a pullback to this long-term average. Additionally, we can see how this works when combined with TradeShark's Neural Index, a 2-day forecasting indicator. TradeShark's Neural Index is alerting to some short-term weakness, which in our bullish view would forewarn of a market consolidation. However, understanding the long-term uptrend conditions are still in place, traders can look to get long the market by identifying the long-term average as an area of support. What you will notice is that the Neural Index quickly confirms the move away from the long-term average and remains bullish for a highly profitable continuation trade. However, let's look at this next example where the triple cross goes bearish. The market does trend lower, but as expected, consolidates toward the long-term average. This is certainly an area of resistance, as we will see the market trade lower off of this level. However, notice how the Neural Index remains quite bullish, signaling that this is not the time for a continuation trade. A trader would be able to avoid any losses and recognize that conditions were not ideal for this trend continuation. By combining these highly accurate predictive tools from TradeShark, traders can ensure that they are putting the probabilities in their favor and get away from positions that are less likely to produce a profit. In addition to identifying areas of support and resistance, the triple crossover helps traders better account for market volatility as a trend develops. For example, look at this chart for Allstate. We can clearly see this market is in a downtrend. However, let's take a closer look. You'll notice TradeShark started forecasting market prices to move lower and a strong downtrend developed. However, because the downtrend was so strong, it greatly increased daily volatility. TradeShark's predicted moving average crossovers do a great job at forecasting prices a couple days ahead, but in certain market conditions, like increased volatility, it may be difficult to manage the position effectively. A trader would have made a lot of money shorting this market, but may have become confused when the market began to consolidate. However, by using the triple cross and understanding where the market is likely to trade, allows traders to anticipate trend continuations. A trader could look towards the long-term average of the triple cross to set more short positions with very little risk, allowing him to make a lot of money on a continuation trade to the downside, but lose very little if proven wrong. Additionally, we can once again see how the Neural Index and triple cross work together, allowing traders to exploit the longer term and shorter term trends in the market. Lastly, traders who prefer to use the triple crossover as a means of identifying trends rather than support or resistance levels may favor its triple crossover alternate. This modified triple cross allows traders to focus on the dominant trend and alerts traders early as to when a trend is likely to change. For example, notice how the short and medium-term crosses act as a guide for when traders can expect strength or weakness within the dominant trend. You will want to use whatever tool most closely matches the objectives of your trading strategy. However, the benefits of predictive indicators allow TradeShark users to anticipate where the market is headed rather than react to where the market has already been. I hope you have enjoyed this demonstration of the TradeShark triple crossover. For more information on additional indicators and the technology that powers TradeShark, be sure to visit www.tradeshark.com.